Welcome back to StockScope. Today, we're moving past the market hype to perform a forensic audit of Bloom Energy's Q1 2026 performance. We are entering what management calls the era of on-site digital power. With a record revenue of $751.1 million reported this quarter, the numbers suggest a fundamental shift in how the AI economy is powered. As always, we provide the engineering data, you decide the verdict.
The top-line acceleration this quarter was unprecedented. Total revenue hit $751.1 million, a 130.4% surge year over year. However, the real story is in the product segment, which exploded 208.4% to $653.3 million. We're seeing a massive adoption of fuel cell monoliths as data centers and semiconductor fabs seek behind-the-meter power to bypass an aging utility infrastructure. Crucially, Bloom has reached a profitability pivot point. GAAP operating income swung to a positive $72.2 million, a massive improvement from the loss reported in Q1 2025. Non-GAAP operating income followed suit, hitting $129.7 million. From an engineering perspective, system mechanics indicate that profitability is now scaling exponentially faster than raw revenue inputs. Positive operational leverage has been formally activated. The margins confirm this breakout. Non-GAAP gross margin expanded to 31.5%. Even the legacy service segment, long a drag on the business, crossed the profitability threshold with a GAAP margin of 13.3%, up from a mere 1.3% just 1 year ago. This led to a non-GAAP diluted EPS of 44 cents, a 1,366% relative expansion from the baseline. Perhaps the most bullish signal was the aggression in the forward guidance. Management raised the full-year revenue outlook by 20%, now targeting a range between $3.4 and $3.8 billion. This overrides previous targets and implies a year-over-year growth of roughly 80% at the midpoint. They are now aiming for a non-GAAP operating income goal as high as $750 million for the year. Why is this happening? Look at the gridlock. Traditional utility interconnections now face 5 to 7 year wait times, stalling massive capital deployments in the AI sector. Bloom Energy servers act as a parallel pipeline, providing swift, zero wait time deployment for digital power. Bloom is no longer just alternative energy. It is becoming the definitive standard for data center infrastructure. To support this ramp, Bloom has built a fortress balance sheet. They ended the quarter with $2.49 billion in cash and equivalents, securing a long operational runway. Operating cash flow saw a $184.3 million swing from burn to generation. We also note an intentional inventory buildup of $732.5 million, engineered specifically to execute the aggressive delivery schedule for the second half of the year. However, the bear case remains focused on system friction. Despite the tech, lengthy sales and utility interconnection delays still throttle deployment speed. Furthermore, Bloom's core growth is now intrinsically tied to AI adoption. Any slowdown in data center expansion directly decelerates their pipeline. Finally, the capital intensity required to scale this hardware remains a high hurdle for long-term equity holders. The bull case is one of sheer velocity. The massive 2026 guidance hike suggests a locked-in, de-risked pipeline for the remainder of the year. Triple-digit product revenue growth proves that demand is already converting into real-world sales. With the legacy service fleet finally printing profit as it scales, the bottom-line expansion could continue to surprise to the upside. The blind spot here is the valuation disconnect. Forward multiples are stretching to decade highs based on exponential AI energy demand. Investors are pricing the equity for a pristine hydrogen future, but today's massive cash flows remain tethered to natural gas inputs. The ultimate engineering question is whether Bloom can drive down stack costs fast enough to compete with plummeting solar and storage rates. Technically, BE is in a high momentum breakout. The price hit maximums 3 days ago, and it's testing a massive traders correction of around 15% in 3 days. We've identified the battle zone, colored in blue, where the volatility is shown as its best and traders are being pushed out of its trades. We think that any price around the $200 zone is a clear entry and should expect a rebound if we test the lower band of the mentioned battle zone. We've presented the audit. The decision is yours. See you in the next analysis.